Hello everyone, we're from Group 1 and today we're presenting about capital budgeting based on Airbnb analysis. And here's our group from Group 1. Before we start, let's introduce the company that we will analyze. So Airbnb is a company, a global leader in the sharing economy, has has revolutionized the hospitality industry by connecting travelers with unique lodging experiences beyond its innovative platform. The company's financial and strategic performance offers valuable insights for stakeholders, analyzing its corporate social responsibility, financial returns and risks, sensitivity to various market factors, and valuation to free cash flow to the firm and free cash flow to equity, highlights Airbnb's strengths, challenges, and future potential. Now, as of its CSR analysis, the business has doubled almost every year of its existence. It became profitable in 2017 with a profit of $93 million on revenue of 2.6 billion. This is a stark contrast from heavily loss-making sharing companies such as Uber and Lyft. It is estimated that in 2018, Airbnb surpassed the performance of the previous year, and by 2020, its revenue is projected to be as much as 8.5 billion. As for the categories and values, examples include such as the short-term investments of $2.224 million and funds receivable and amounts held on behalf of customers of around $6,874 million. A section related to return and risk analysis is presented but partially filled, including metrics like a debt to equity ratio with a value of 1.528. As you see, it's a debt to equity ratio based on its formula, total liabilities divided by equity, um, which values are about 12,480 million, and an equity of 8,165 million, which resulted in $1.53. To calculate the current ratio, you current assets divide by current liabilities, which gives you 16,509 million divided by 9,944 million, which resulted to 1.66. As of its ROA, net income divided by total assets, so 4,792 million divided by 20,645 million, which gives you at around 23.21%. Its ROE, net income divided by total equity, 4,792 million divided by 8,165 million gives you 58.67.
Okay, next I'm going to explain about return and risk analysis. So this is the data from 2024 from Airbnb. So we're going to explain about debt to equity ratio first. First of all, to calculate it, we just have to divide total liability, which is 12,480, with total equity, which is 8,165. And it shows 1.53. This indicates a very moderate leverage, indicating a balanced mix of debt and equity financing. Next one is current ratio. We get this number from total current assets, which is 16,509, divided by total current liabilities by 9,950. This shows a good liquidity to cover short-term obligations. And then next one, there's ROA, or return of assets. We can get this number, the 23, by dividing the net income of 4,792 with 20,645. We'll get 23%. This indicates Airbnb generated 0.23 cents of net income for every $1 of assets in 2024, reflecting efficiency of used assets. Lastly, in return analysis, I'm going to explain about return of equity or ROE. It's simple, you just have to divide the net income with total equity. That's 4,792 divided by 8,165. And then we'll get 59%. This demonstrates a very strong return for shareholders, showing a high profitability relative to equity and investment. That's all for return analysis. Thank you.
Okay. So for investment analysis, we did FCFF. So first we make the purchase list where we already have the information of offer price, which is 75 7 yeah 75,000. So the down payment was 20%. So we need the down payment in dollars. So the way we calculate is 750,000 times 20%, and we get 150,000. And we also have investment closing cost, which is 2%. Now we need it in dollars. The way we calculate is the 750,000 times 2%, and we got 15,000. And this is the information we already had. 20 renovation cost, setup cost is already there. So now we calculate total investment, which is the sum of 150,000, 15,000, 20, and 10,000, and we get 195,000. Now we do the expense. The expense we already had. First, we calculate the mortgage amount, which is the here we minus from 750 minus 150, and we get 60 or 600,000. This is the term in years, which is 30 years. And number of payments is 360. Interest rate, we already have this information, is 5.50. And monthly principal interest, we calculate by using the formula, which is PMT, and we divided 600,000 and also 360, and also the interest rate, and minus by 1, and we get 3,406.73. Now we calculate the estimated property tax, which is yearly. This is how we do it. We times 483 times 12, which is for 12 months, and we got 5,769. And this is the insurance yearly, and we only have the monthly information, which is 125. So we times it with 12, so we can get yearly insurance rate, which is 1,500. And also we calculate the Airbnb fee, which is the monthly fee is $221, and we times it with 12 for a year, and we get 2,650. And this is the information for cleaning fee and cable internet fee and everything. So now we calculate the maintenance. We have the percentage for maintenance. Now we got it in dollars, which is we divide and sum everything here, and we get 264. Now we calculate the operating expense monthly, which is all the sums in here. So we sum it up: property tax, insurance, monthly HOA, monthly utilities, and so on and on. And we get 2,703. Now we calculate the annual expense, which is we just time it with 12. This is the monthly expense, 2,703 times 12, and we get 32,432. Now we do the total expense monthly, which is here. This is the monthly. We just sum the operating expense and also the monthly principal interest, which will get the total expense is 6,109. Now we get the annual expense by timing it with 12, and we get 73,312. Now we calculate the income statement, which is we already have the gross income and we times it with the with 12, so we can get the yearly income, which is 88,336. Now we do the average uh, net operating income, which is just we minus it from the gross income yearly and the operating expense annual, and we get 88,336. Now we calculate the cash flow, which is first we calculate monthly cash flow. And the way we do it is we minus from total expense minus gross income, and we get 1,252. The way we calculate yearly cash flow, which is just times it with 12. So cash flow times 12, we get 15,024. So this was the investment analysis, just the income statement. And now we dive into the deeper analysis, which will be presented by Krishna.
Okay, so to dive deeper into the FCFF calculation, we must first address the first data, which was the annual increase in gross income in percentage, which will be 2%, and the annual increase in operating expenses, which will be 3%. We'll also need to address the annual appreciation, which is also 3%. So, to get the annual gross rental income, we first need to take the initial data, which is $88,336. And to get the following data, calculate, we must first take the initial data, multiply it by the annual increase in gross income, then we added the initial data as well. So the annual gross rental income, which is $88,336, multiplied by 2%, and added by again $88,336, we will get $90,103. While for the annual operating expense, we also need to take the initial data, then multiply by annual increase in operating expenses, which will give us, and also don't forget to edit the initial data as well to edit it, and we will get $33,405. While for the mortgage debt, we will take the initial data from the first file, then we multiply by 12. And also it works in every phase of this calculation. For mortgage, no, for cash flow, we would we need to minus everything. We would need to take all of this data, then minus everything. So the annual gross rental income minus annual operating expense, then minus mortgage debt, which will result us in this amount. Same with the other calculation in the following. While for monthly cash flow, we just need to take this data from cash flow, then we divide by each and every month in a year, we would get the $1,252. And for the following data, we would need to also do the same. So uh, for the cash on cash return from initial investment, we must take this data and then also take the data from the before. And for property value, we also need to take the data from before. As for the amount owned, we would need to take the principal pay down, which I will be getting to in a second, same as the next data. And the equity, we need to sum the property value. We need to take the no actually we need to take the property value and amount owned, minus them, and then sum it, which will get us this data. As for the following data, we should do the same as well, but we would not need to edit the sum. Okay, so moving on into the following data, we would go to mortgage amount, which will give us this amount. Oh, okay, so to get the interest, we must first multiply this data from the mortgage amount, which is $600,000, and the interest monthly, which is gonna be 0.46%. Then we also multiply for every month, which is gonna be 12 months, which is gonna give us $33,000. As for the monthly pay, as for the principal pay down, we need to uh, take the mortgage amount, then minus it with the monthly payment, and then we added the interest, which is $33,000, will give us in the amount of $592,119. And the following data would be the same as well. So to get the final data, we need to take every increasing data from here, and then we summarize it. Uh, from here we can get like the annual gross rental income. So we would summarize. We should sum it, and then we get the $459,706. For the total operating expense, we also need to sum the annual operating expense as well from every moving data that we got here. The total mortgage payments would also be the same. As for the total cash flow, we also do the same as well, but for the average monthly cash flow, we need to sum every data, moving data, and then we divide it by 5. So we would get this amount. So for the increase in value, we would need to take the highest data, which is gonna be 800, and we would need to take the highest amount, which will be $844,132. Then we minus them by the lowest data, which is $750,000, which will get us a 94,132 increase in value. As for the mortgage paydown, we need to take the highest data and then minus them. We actually need to take the lowest data and then minus them with the highest amount. which will get us a loss of $36,103. As for the total of the appreciation and cash flow, we would need to take the total cash flow and add that by added it with increase in value, which will get us a $177,250. And the return on initial investment will be 91%. As for the net proceeds after sale, the and 3% agent commission, we must first take the data from property value and then we multiply it by 0.03, and then we also uh, minus it by the property value as well. Then we minus the data with the amount owned, which will get us a $262,791. So that is a comprehensive guide, a comprehensive overview for the FCFF data.
All right, for the last analysis would be the sensitivity analysis. Sensitivity analysis is sensitivity analysis shows how different values of an independent variable affect a dependent variable under a given circumstances. It is a method that studies how the outputs of a system are influenced by its inputs. It is used to determine how an assessment is by examining how changes in methods and models or assumptions affect the results. It is also known as uncertainty important analysis. I will show the Excel. Can you see my screen?
Yes.
All right, so for a multi-billion-dollar company as Airbnb, it has an annual sales of around 8 billion as of 2023. And in sensitivity analysis, we project the worst and best scenario in a duration of around 10 years. Let's say in this part is 10 years. So it's a projected cash flow in the duration of 10 years. In the worst case scenario, we would have 2 billion annual sales, 8 billion in the expected sales, and 15 billion in the best case scenario sales. We have a variable cost of 66.67%. And we can by that we can calculate the variable cost in dollar, which would be annual sales multiplied by the variable cost in percent and divided by 100, and we get 1,333,004,000. For the expected case, we have 5,333,006,000, and the best case would be 10,005,000. We have a fixed cost of around 300 million for annual fixed costs and the depreciation of around 500 million. This is normal for a multi-billion-dollar company as an Airbnb. And the pre-tax profit we can calculate by subtracting the annual sales with the variable cost, fixed cost, and depreciation. we have a tax rate of around 25%. So we can calculate the tax because we need this for our end results, which is net present value for the projected results in 10 years for our sensitivity analysis. So we calculate the taxes by multiplying pre-tax profit with tax rate divided by 100, and we get 4,091,665. For the expected case, we have 18,991,660, and best case would be 36,374,988. The profit after tax is basically the pre-tax subtracted with the taxes, which would be 1,600,000,000, 7,577,000,000, and 14,513,000,000. The cash flow operations would be calculated by depreciation subtracted with profit after taxes, which would be 1,682,000,000, 7,627,000,000, and 14,563,000,000. Airbnb has a discount rate of 12% and a PVFA of 5.65. So by that we can calculate the net present value, which is minus depreciation plus cash flow from operations and the PVIFA, which we get 9,456,000,000, 43,046,000,000, and 82,234,000,000. That's all from the sensitivity analysis. Uh, we may go for the conclusion for the next presenter.
Okay, thanks to everyone that have been presenting their mathematical and also Excel of the analysis of Airbnb, and let's go to the conclusions. And the conclusion is that Airbnb shows a strong financial performance with a 23.21% of ROA and 58.67% ROE, highlighting efficient operation and shareholder value, moderate leverage of 1.553 why sorry DE, and strong liquidity of 1.66 on current ratio that ensures stability. Growing free cash flows and rising investor confidence underscore robust financial health, with 2024 projections showing high revenue potential despite some demand vulnerabilities. Next is And also, despite that, we have some recommendation for Airbnb. And first is maintain profitability. Continue leveraging asset-light business models and enhance platform efficiency to sustain the ROA and the ROE levels. Second is debt management. Monitor leverage to avoid over-reliance on debt, especially under unfavorable market conditions. Three is scalability and diversification that expands listings and explore new market to reduce risks tied to regional regulation and competition. And lastly, optimize pricing strategies. Ensure pricing flexibility to adapt to varying demands and conditions while maintaining revenue growth. I think that's all I could say. Thank you.
That's all for today's presentation, and thank you for listening.